What if 2026 is not just another year in the economic cycle, but the year growth finally cracks? For the past few years, markets have been pricing in resilience, strong labor data, stable consumption, corporate earnings holding up better than expected. But underneath that surface, the structural pressures are building. GDP, gross domestic product, is the broadest measure of economic activity. It reflects consumption, investment, government spending, and net exports. When GDP slows meaningfully, everything else follows: corporate earnings, hiring, credit expansion, and asset prices. Right now, several forward-looking indicators are flashing caution. First, the lag effect of higher interest rates. Monetary tightening does not hit immediately. It works with delays, often 12 to 24 months. The aggressive rate hikes of 2022 and 2023 are still filtering through refinancing cycles, commercial real estate loans, and corporate debt structures. Many businesses that locked in cheap debt are now facing significantly higher rollover costs. Second, fiscal sustainability. Government spending has been supporting headline growth, but rising interest payments are crowding out flexibility. When debt servicing costs grow faster than revenue, future stimulus becomes constrained. That changes the trajectory of GDP. Third, productivity growth. Without strong productivity expansion, the economy struggles to grow above trend. Demographic headwinds and slower labor force growth add further pressure. So what would a GDP shock in 2026 actually look like? It wouldn't necessarily mean a dramatic collapse. More likely, it would begin as a measurable deceleration, growth dropping below trend, corporate earnings revisions turning negative, business investment slowing. Markets tend to anticipate this well before official recession declarations. A key question is whether this potential slowdown is cyclical or structural. Cyclical slowdowns are part of normal economic fluctuations. Structural slowdowns are deeper, tied to demographics, debt saturation, and long-term shifts in global trade. If 2026 brings a cyclical downturn, policymakers can respond with rate cuts and fiscal adjustments. But if the slowdown reflects deeper structural limits, recovery could be slower and more uneven. Markets are forward-looking mechanisms. Equity valuations depend heavily on future earnings growth. If GDP growth expectations are revised lower, price-to-earnings multiples adjust accordingly. Bond markets, meanwhile, react through yield curve shifts and credit spreads. The risk is not panic. The risk is repricing. Investors who assume perpetual above-trend growth may find themselves adjusting expectations quickly. The question is not whether a slowdown is possible. Every expansion eventually matures. The real question is timing and whether current valuations fully reflect macro risk. If growth in 2026 undershoots projections, the shift won't happen overnight. It will show up gradually in investment decisions, hiring freezes, weaker retail demand, and tightening credit. GDP shocks rarely announce themselves dramatically. They build quietly. So as we move closer to 2026, the focus should not be on fear, but on positioning. Because the difference between panic and preparation is understanding the data before the headlines change. And right now, the data suggests caution, not collapse, but caution. The next 12 months may determine whether 2026 becomes a year of adjustment or a year of surprise.
There's a number that matters more than quarterly headlines, and that number is debt relative to growth. The United States has been expanding nominal GDP, but at the same time, total federal debt has grown at an even faster pace. When debt grows faster than output, sustainability becomes a mathematical issue, not a political one. GDP growth is the engine that supports debt. Without sufficient growth, servicing that debt becomes increasingly expensive. Now, consider the environment heading into 2026. Interest rates are no longer near zero. The cost of refinancing government bonds has risen. Each new issuance carries higher interest obligations. As old low-rate bonds mature, they're replaced with higher-yielding ones. That means interest payments as a share of federal spending are increasing. Here's where it connects to GDP. When more fiscal resources go toward servicing debt rather than productive investment, the multiplier effect weakens. Infrastructure, education, research, these generate long-term growth. Debt servicing does not. If GDP growth slows at the same time that interest payments rise, the fiscal constraint tightens further. Markets understand this relationship. Bond yields reflect inflation expectations, growth expectations, and fiscal credibility. If investors begin questioning long-term fiscal balance, risk premiums rise. Now imagine entering 2026 with slower growth momentum and elevated refinancing costs. Corporate America faces similar dynamics. Many companies issued cheap debt during ultra-low rate periods. As that debt matures, higher rates pressure margins. Lower margins mean reduced reinvestment and hiring. This is how debt pressure quietly feeds into GDP. The economy doesn't collapse instantly, it compresses. Investment becomes more selective, hiring becomes cautious, credit standards tighten. The danger isn't just high debt, it's high debt during slowing growth. Historically, economies can manage large debt burdens if growth remains strong, but when growth decelerates below borrowing costs, sustainability shifts. That's the setup analysts are watching for in 2026, not a sudden financial crisis, but a growth squeeze. The broader implication is this: fiscal stimulus becomes less effective over time when debt service crowds out flexibility. If GDP growth in 2026 comes in weaker than expected, the market reaction will not be about emotion, it will be about recalibration. Because growth justifies leverage, and when growth slows, leverage becomes heavier. The real risk of a GDP shock isn't panic, it's recognition. Recognition that the growth trajectory may not support the debt trajectory indefinitely. And once markets internalize that dynamic, repricing tends to follow. Which makes 2026 less about recession headlines and more about structural balance. The next phase of this cycle will test how durable growth truly is under elevated debt conditions.
Markets don't wait for recessions to be declared. They price in expectations months, sometimes quarters, in advance. So if GDP shock risks are building toward 2026, asset markets will move before the data officially confirms it. Let's start with equities. Stock prices are ultimately a function of earnings expectations and valuation multiples. When GDP growth slows, revenue growth slows. When revenue growth slows, earnings projections are revised downward. Even modest downward revisions can have outsized impacts when valuations are stretched. In high-growth sectors, expectations matter more than current results. A slowdown narrative alone can compress multiples even before earnings materially decline. Now consider credit markets. Corporate bond spreads tend to widen when economic risk rises. Investors demand higher compensation for default risk. That increases borrowing costs and tightens financial conditions further, reinforcing the slowdown. This feedback loop is subtle but powerful. Then there's the labor market. GDP slowdowns typically show up in hiring first, slower job creation, reduced overtime, softer wage growth. Consumer confidence follows, consumption weakens, and because consumption drives the majority of GDP, that weakness compounds. Bond markets respond differently. If growth slows but inflation remains contained, yields may fall. That can cushion parts of the financial system. However, if fiscal concerns dominate, yields could remain elevated despite slower growth. That's the complicated balance entering 2026. Markets will have to weigh inflation, debt sustainability, monetary policy response, and real economic momentum simultaneously. Historically, GDP shocks don't mean permanent collapse. They mean revaluation. Overpriced assets reprice. Overextended balance sheets correct. Capital becomes more selective.
Long-term investors understand that volatility creates opportunity, but only when risk is properly assessed. The most dangerous environment is one where complacency dominates. If expectations for 2026 assume smooth, uninterrupted growth, even a modest slowdown becomes disruptive. The shift from optimism to realism is rarely gradual. It happens quickly. That doesn't imply crisis, it implies adjustment. And adjustment periods often reward disciplined positioning over emotional reaction. GDP is not just a statistic, it is the backbone of corporate earnings, fiscal sustainability, and asset valuations. If that backbone weakens, markets adjust accordingly. The key question is not whether volatility will return, it's whether participants are prepared for it. Because the difference between a shock and a transition often lies in expectations, and 2026 may be the year expectations are tested.
If 2026 becomes a GDP shock year, the real story won't be the contraction itself. The real story will be what it changes. Because every meaningful slowdown in modern history has forced a strategic reset in markets, in policy, and in capital allocation. This is not just about whether growth slows, it's about what kind of economic era we are entering. For decades, global growth operated under three powerful forces: cheap capital, expanding globalization, and demographic momentum. Those forces amplified GDP. They supported rising asset prices. They justified expanding leverage. But today, each of those pillars looks different. Capital is no longer free. Even if rates decline from current levels, the ultra-low rate regime that defined the 2010s is unlikely to return in the same structural form. Globalization is fragmenting. Trade flows are being rerouted. Supply chains are being reshored or diversified. That process reduces efficiency, and efficiency was a major driver of prior GDP expansion. Demographics in developed economies are slowing. Labor force growth is no longer automatic. Productivity must compensate, and productivity gains are uncertain even with technological innovation. So, if 2026 brings a GDP shock, it may not be an isolated event. It may be the market's recognition that structural growth assumptions need recalibration. Grand strategy is not about reacting to a single data print. It is about recognizing regime change. A cyclical slowdown can be solved with rate cuts and stimulus. A structural slowdown demands reallocation of capital and expectations. Investors often ask, what happens to equities in a GDP shock? The better question is, which equities? In a lower growth regime, capital becomes selective. Companies with strong balance sheets, pricing power, and real productivity advantages outperform those reliant on cheap financing and aggressive expansion. Debt-heavy growth models struggle in tightening liquidity environments. Government policy also shifts under grand strategy conditions. When growth weakens structurally, governments face a dilemma: stimulate aggressively and risk fiscal instability, or consolidate and accept slower growth. Neither path is politically simple. This creates volatility, not chaos, but tension. Bond markets become more influential, currency dynamics shift, capital flows adjust toward stability rather than speculation. Emerging markets dependent on U.S. demand feel the spillover. Commodity cycles adjust, trade balances rebalance. The dollar itself becomes a strategic variable. In slow growth environments, reserve currency dynamics matter more, not less. What makes 2026 potentially pivotal is timing. We are late in a credit cycle. Asset valuations remain elevated relative to historical norms. Fiscal deficits are large. Global trade patterns are changing. If GDP growth decelerates meaningfully within this context, the narrative transitions quickly from temporary slowdown to structural reset. And resets do not mean collapse, they mean repricing. They mean capital becoming disciplined again. They mean the market rewarding fundamentals over momentum.
Historically, periods following structural slowdowns have produced some of the most powerful long-term opportunities, but only for those who understood the shift early. The danger is not recession. The danger is misreading the regime. If investors assume that the next cycle will look like the previous one, positioning may lag reality. Grand strategy thinking requires stepping back. Instead of asking, will GDP decline? Ask, if growth is structurally lower for the next decade, what does that imply for asset allocation? It implies a premium on quality, on balance sheet strength, on durable cash flow, on sectors aligned with productivity rather than leverage expansion. It implies volatility clusters rather than smooth expansion. It implies that policy response will be reactive rather than proactive. And it implies that capital will demand higher returns for taking risk. The most powerful shifts in markets rarely feel dramatic in real time. They feel gradual until suddenly they are obvious. 2026 may not deliver a crisis, but it may mark a turning point, a moment where markets collectively acknowledge that the growth regime has changed. And once that acknowledgement occurs, strategy must change with it. Because the investors who succeed in the next cycle will not be the ones who predicted headlines. They will be the ones who understood the structure and positioned accordingly.